Silicon Valley Bank. What is it? What happened? And what are the implications? Silicon Valley Bank, or SVB, is a commercial bank headquartered in the San Francisco Bay Area with offices in 13 countries and regions. Its main customers? Startups. These startups, after raising capital from venture capital firms, would deposit their funds with SVB. By the end of 2022, SVB was the largest bank in the Bay Area by deposits. So what went wrong? Did SVB do something egregious? Probably not. Like any other bank, SVB would hold a small portion of the deposits as cash reserves and invest the rest. In their case, mostly in relatively safe, low-risk US Treasury securities, notes or bonds as we call them, and in mortgage-backed securities. Back in 2020, investing in a 20-year Treasury bond would yield less than 1%. Very low, but it was considered safe. And mortgage rates were very low as well. So the low-risk mortgage-backed securities that SVB invested in would have probably returned around 3%. Again, low returns but low risk. Unfortunately, something else happened. To combat the rising inflation, the Fed started raising the Fed funds rate from 0 a few years back to around 4.5% where it stands today. But how did this affect SVB? Remember that SVB, like most banks, would hold only a small portion of deposits in cash reserves. As long as depositors were withdrawing only small amounts to meet their expense, these withdrawals could be handled with the cash reserves. But what would happen if there was a bank run from a whole bunch of depositors? That is, a huge number of depositors wanting to withdraw their deposits from the bank at the same time. SVB would not have that much cash in its reserves and would have to sell some of its investments, right? And that is where the problem starts. Remember the low risk, low returns treasury and mortgage-backed securities that SVB invested in? As a result of the Fed increasing its rate over the last 2 years, the yield or return on new treasury and new mortgage-backed securities today is much, much higher. This makes those older investments that SVB has very unattractive. Those treasury securities would have lost value to make up for the increased yield today, and those mortgage-backed securities from 2020 cannot compete against today's offerings that return much, much more. In short, SVB would have to sell its investment at a loss. And that loss adds up when more and more depositors want their money immediately. And it reached a point where SVB did not have enough money to pay back all the depositors immediately. And that is where we are today. So why did the depositors make a bank run? Well, hedge funds and short sellers realized what could possibly happen if there was a bank run and started betting against SVB's stock. Then credit rating agencies followed up with bringing down SVB's rating, and before you knew it, panic had set in. And the depositors, even though they knew that if they all withdrew money from SVB at the same time, it could land the bank in trouble, did the exact same thing, and the bank collapsed. In today's intricately interconnected world of finance, the most important element is trust. But once there is fear, that trust is broken. And when that happens, any bank, any financial institution, or any government could collapse. So what happens now? The Feds, the FDIC to be precise, has taken over the bank. FDIC's first focus would be to return the insured portion of each depositor. That is the first 250K of their deposits. Then it would liquidate or auction the rest of the assets and try to return as much money as possible to the depositors. And they've been mostly successful in doing this. After this, it would try to return money to SVB's creditors. This is a tough process because with the depositor base in panic, short sellers adding pressure, and an aggressive social media, there are so many things that could go wrong. And finally, to the investors in SVB's stock. Unfortunately, those are the ones at the highest risk. In summary, did SVB do something crazy? Probably not. So is it just a victim of circumstances? Well, for that we have to discuss the Dodd-Frank Act, and that's a discussion for another day.